What if you woke up tomorrow and discovered that your hard-earned savings were worth far less, or even locked away beyond your reach? Millions of people across the UK face this exact hidden danger, and most don't even realize it. From inflation silently eating your money, to new banking rules that could seize deposits, the risks are far greater than you've been told. In this video, we'll uncover the 10 shocking reasons your savings could be at risk, and more importantly, what you can do to protect yourself before it's too late. Number 10. Shift towards a cashless society. The UK is rapidly moving toward a cashless society, where physical money plays a smaller role in daily transactions. Contactless payments, mobile banking apps, and even trials of central bank digital currencies signal a future where cash may become obsolete. While this transition offers convenience, it also raises serious risks for savers. With every transaction tracked digitally, governments and banks gain more control over personal finances, potentially limiting how money is stored or spent. In a cashless environment, individuals lose the option to hold wealth privately, making them fully dependent on digital systems that may impose restrictions, fees, or even penalties. For savers, this shift represents a fundamental change in how financial freedom is defined. Another concern is the vulnerability of digital-only money to technical failures, cyber attacks, or policy changes. In a purely cashless system, even temporary outages could leave millions unable to access their funds. Worse, the introduction of programmable money under CBDCs could allow authorities to set expiration dates on savings, restrict purchases, or monitor spending habits in unprecedented detail. While advocates argue that such systems reduce fraud and increase efficiency, critics warn they could erode individual privacy and limit personal choice. For savers, this means wealth is not only exposed to economic risks, but also to the decisions of policymakers and the reliability of technology. The loss of tangible cash removes an important layer of independence that has historically protected individuals during times of financial uncertainty. To prepare, savers can take proactive steps to maintain resilience in a cashless future. Diversifying into physical assets such as gold, silver, or property ensures that wealth is not entirely tied to digital systems. Maintaining some access to offline emergency funds, even in smaller amounts, provides a safety net if digital networks fail. Staying informed about government policies on digital currencies allows individuals to anticipate and adapt to changes before they take effect. Above all, recognizing that the shift to a cashless society is more than just a convenience, it's a transformation of financial power, is essential. By planning ahead, savers can protect their independence and ensure their money remains truly under their control. Number 9. Inflation of housing and everyday essentials. One of the biggest drains on personal savings in the UK comes not from banks or policies, but from the skyrocketing cost of housing and daily necessities. Over the past decade, house prices and rental costs have climbed at a pace far faster than wages, forcing millions of households to rely on savings just to keep up. For first-time buyers, deposits now demand tens of thousands of pounds, often wiping out years of hard saving. For renters, constant increases in monthly payments leave little room to save at all, while many turn to emergency withdrawals from savings accounts simply to cover bills. When savings are being consumed to cover basic living costs, the ability to grow wealth for the future is severely undermined. The problem doesn't stop at housing. Everyday essentials like food, energy, and transportation have also risen dramatically in price, fueled by inflation and supply chain pressures. Recent surveys show that over half of UK households have had to dip into their savings to afford these basic needs. For families already stretched thin, savings accounts become lifelines rather than growth tools. What was once set aside for emergencies, education, or retirement is now used to pay electricity bills or buy groceries. This shift fundamentally changes the role of savings in people's lives, from security and opportunity to mere survival. And as costs continue rising, many risk depleting their reserves entirely, leaving them exposed to future shocks. Addressing this challenge requires both strategic planning and discipline. Savers should consider creating a budget buffer, allocating money specifically for rising living costs while protecting a portion of savings from being touched. Building an emergency fund separate from long-term savings can prevent total depletion when bills spike unexpectedly. Exploring ways to increase income, such as side hustles or skill development, can also help offset the pressure on savings. Additionally, finding opportunities to cut unnecessary spending through bulk purchasing, energy efficiency, or better insurance deals can free up money to protect financial reserves. While individuals cannot control the housing market or global inflation, they can control how they adapt. By balancing present needs with future planning, households can stop rising costs from fully consuming their hard-earned savings. Number 8. Hidden bank fees and erosion. Many people assume that savings accounts are completely free, but in reality, hidden bank fees quietly erode balances over time. These costs come in many forms: monthly account maintenance charges, penalties for dipping below minimum balances, or fees for certain types of transfers. While each individual charge may seem small, together they can add up significantly over months and years. For savers working hard to build financial security, the idea that banks are quietly taking slices of their money can feel frustrating and unfair. Worse still, many people are unaware these deductions exist, as they are buried deep in the fine print of contracts and disclosures. Another subtle way savings lose value is through uncompetitive interest rates that act as an indirect fee. A bank may advertise a special offer on a savings account, but once the promotional period ends, the interest rate often plummets. Savers who fail to move their money are essentially penalized by earning far less than they should. This practice benefits banks enormously while costing customers real purchasing power. Some accounts also include restrictions, such as limits on the number of withdrawals allowed each year, with penalties for exceeding them. These hidden traps are designed to maximize profit for the institution rather than reward loyalty. Over time, they erode confidence in the banking system and discourage healthy saving habits. Fortunately, savers are not powerless against these practices. The most effective step is to regularly review account statements and check for small but recurring deductions. Comparing offerings across different banks and switching to fee-free accounts ensures money is not silently wasted. Some digital banks and credit unions are more transparent, offering straightforward accounts without hidden costs. Savers can also benefit from setting reminders to review interest rates after promotional periods, preventing losses through complacency. In addition, understanding the terms and conditions before opening an account avoids unexpected surprises later. The key is to treat savings accounts not as static tools, but as financial products that require active management. By staying alert and choosing wisely, individuals can prevent hidden fees from quietly eating away at the very funds they work so hard to build. Number 7. Digital banking risks and cyber threats. As banking becomes increasingly digital, the convenience of online access comes with serious risks. The UK has seen a sharp rise in cybercrime, with hackers targeting both individuals and financial institutions. From phishing scams to sophisticated malware attacks, criminals now have more tools than ever to steal savings with just a few clicks. Even when stolen money is eventually refunded, victims often face weeks of stress, paperwork, and uncertainty. For larger-scale breaches, the consequences could be far worse. In extreme scenarios, coordinated cyber attacks could disrupt entire banking networks, freezing access to funds and leaving millions unable to make payments. For savers who rely solely on digital banking, this represents a significant vulnerability. While banks invest heavily in cybersecurity, the reality is that no system is completely secure. Criminals constantly evolve their methods, exploiting weaknesses faster than institutions can fix them. Even beyond outright theft, digital risks include account lockouts, technical failures, and data breaches exposing sensitive financial information. For example, a simple systems outage could temporarily block access to money, problematic in emergencies when quick withdrawals are essential. Moreover, as societies move toward a cashless economy, the reliance on digital infrastructure only grows. This makes everyday savers increasingly dependent on systems that may be targeted or disrupted, intentionally or accidentally. The illusion of instant access to savings is shattered the moment technology fails or becomes compromised. Protecting savings in a digital world requires both vigilance and strategy. Individuals should use multi-factor authentication, strong unique passwords, and secure devices to minimize personal risk. Regularly monitoring accounts and setting up alerts can help detect unusual activity early. Beyond personal precautions, it is wise to keep a portion of funds in alternative forms, such as premium bonds, physical savings, or emergency cash reserves. This ensures that if online accounts are ever frozen or hacked, access to essential money remains possible. Savers should also consider spreading their wealth across multiple institutions, reducing exposure if one bank suffers a cyber attack. Ultimately, digital banking offers great convenience, but awareness of its vulnerabilities is critical. By preparing for cyber threats, individuals can protect their savings from disappearing into the shadows of the digital world. Number 6. Currency devaluation. When people think about the safety of their savings, they often overlook the role of currency value. Yet the British pound itself can lose strength against other major currencies, leaving savers with less purchasing power on a global scale. Currency devaluation means that the same amount of pounds buys fewer dollars, euros, or other international goods and services. This becomes particularly painful when importing essentials like fuel, food, and technology, as rising costs quickly spill into everyday life. For savers, this erosion is subtle but powerful. Even if their bank balance remains the same, their ability to afford goods abroad or buy imported products at home is weakened. The UK has already experienced sharp periods of currency weakness. Events such as Brexit and global financial crises triggered significant drops in the pound's value. More recently, policy missteps and uncertainty over government borrowing caused further turbulence in foreign exchange markets. Each decline hit households directly by raising inflation and making travel, education abroad, or overseas investments more expensive. For savers who dream of retiring in another country or sending children to study internationally, a weaker pound can completely disrupt those plans. Worse still, currency devaluation can feed a vicious cycle. As the pound falls, imports become pricier, driving inflation higher, which in turn reduces the real value of savings even more. Protecting against this risk requires a mindset shift, thinking not just in terms of pounds but in terms of global value. Diversifying savings into assets tied to foreign currencies or international markets can help shield wealth from a falling pound. Some savers open multi-currency accounts or invest in global index funds, ensuring that at least part of their wealth grows alongside stronger economies. Others choose to allocate into assets traditionally resilient against currency declines, such as gold or commodities. Staying alert to economic signals, such as interest rate policies, trade balances, and political instability, can also provide early warnings of potential devaluation. The important point is that while individuals cannot control the pound's trajectory, they can take proactive steps to ensure their savings hold value, not only in the UK but in the wider world. Number 5. Government debt and policy shifts. The UK's rising national debt poses a hidden but powerful threat to ordinary savers. With debt levels surpassing trillions of pounds, the government is under enormous pressure to find new revenue streams. While direct tax hikes often face political resistance, stealth taxes on savings have become an easier path. These include reducing tax-free allowances, lowering thresholds for capital gains, or freezing limits on individual savings accounts ISAs. For everyday savers, these subtle changes may not seem dramatic at first, but over time, they chip away at the money people thought was secure. The reality is that when government debt grows, the savings of citizens often become a convenient target for balancing the books. This issue is not just about taxation, it's also about policy uncertainty. Shifts in government strategy can directly affect the value and security of savings. For instance, changes to pension rules, dividend taxes, or inheritance tax thresholds can dramatically alter financial plans that people have relied on for decades. Each new administration brings the possibility of reforms, leaving savers exposed to sudden rule changes. During times of financial stress, governments may even impose extraordinary measures, such as limits on withdrawals or restrictions on moving money abroad. While such steps may be described as temporary, history shows they often leave lasting scars on financial security. For those who assume that policy will remain stable, this unpredictability creates a serious hidden risk. Savers can take steps to guard themselves against the consequences of government debt and shifting policies. Maximizing existing tax-free allowances while they are still available is one practical move. Diversifying savings across different instruments, including global investments and tangible assets like property or precious metals, can also reduce exposure to sudden domestic policy changes. Staying informed about new budgets, tax reforms, and government debt reports allows savers to anticipate and adapt before changes take effect. The key message is that while government policy is beyond personal control, individuals can control how they prepare. By thinking ahead and not relying solely on official promises, savers can strengthen their resilience against the risks created by a heavily indebted state. Number 4. Pension fund instability. For decades, pensions have been seen as a guaranteed safety net for retirement. But recent events show this belief is not as solid as many think. Pension funds rely heavily on investments in government bonds, equities, and financial markets to generate returns that match their long-term obligations. However, when markets become volatile, these funds can face serious shortfalls. In 2022, the UK experienced a major pension crisis, triggered by the sudden fall in government bond prices. This exposed how fragile the system can be, forcing emergency interventions by the Bank of England. For savers who believed their pensions were untouchable, it was a wake-up call that even these supposedly safe instruments are not immune to financial shocks. The problem is compounded by the fact that many pension schemes are already underfunded, meaning they do not hold enough assets to meet their future obligations. With an aging population and longer life expectancies, the pressure on these funds continues to grow. For private pensions, mismanagement or overly risky strategies can lead to devastating outcomes, while public pensions face political risks, such as shifting rules, delayed retirement ages, or reduced payouts. Many workers may contribute faithfully for decades, only to discover that their pension delivers far less than expected when they finally retire. For those without alternative savings, this shortfall could severely damage their quality of life in later years. There are ways individuals can protect themselves from the uncertainty of pension fund instability. Reviewing pension statements regularly and understanding exactly how funds are invested is a crucial first step. Diversifying retirement savings across multiple vehicles, such as ISAs, private investments, or even property, can reduce reliance on a single source of income. Some savers also consider shifting a portion of their pension into self-invested personal pensions, SIPs, which provide more control over investment choices. While pensions remain an important cornerstone of retirement planning, treating them as the only solution is increasingly risky. The lesson is clear. Relying solely on pensions without additional financial strategies could leave retirees exposed. Taking proactive steps today helps ensure that retirement savings remain a source of stability rather than a looming uncertainty. Number 3. Banking failures and bail-ins. Most people believe that money deposited in a bank account is completely safe, but history shows this isn't always true. Banks, like any business, can fail when they take on too much risk or face sudden financial shocks. In the past, governments used bailouts, injecting taxpayer money to rescue failing banks. However, since the 2008 financial crisis, the rules have changed. The UK and many other countries now follow the concept of bail-ins. This means that instead of governments covering losses, the burden can legally fall on the depositors themselves. In a worst-case scenario, a portion of your savings could be seized to stabilize a collapsing bank. While this may sound extreme, real-world examples exist, such as Cyprus in 2013, where depositors saw part of their money disappear overnight. The frightening part is that many savers are not even aware of these rules. Although the Financial Services Compensation Scheme, FSCS, protects up to £85,000 per person, per bank, amounts beyond this are vulnerable in the event of a failure. For wealthy individuals, business owners, or even families who have built up larger nest eggs, the risk is very real. And while large bank collapses feel unlikely, even mid-sized failures can ripple through the system, causing panic and reducing trust in traditional savings institutions. In today's interconnected world, a bank crisis in one country can trigger turbulence elsewhere, leaving depositors uncertain about whether their funds are secure. The smart approach is not to avoid banks altogether, but to practice diversification. Spreading savings across multiple banks ensures that more of your deposits remain within protected limits. Additionally, keeping a portion of wealth in safe haven assets such as gold or government bonds can reduce reliance on banks altogether. Savers should also stay informed about their bank's financial health, as publicly available reports often reveal whether a bank is strong or struggling. The important lesson is that the old idea of the bank will always protect me is outdated. By recognizing the reality of bail-ins and preparing accordingly, individuals can make sure their hard-earned savings are not at risk of vanishing in a financial storm. Number 2. Interest rates versus savings rates. One of the most frustrating realities for savers in the UK is the clear mismatch between interest rates and savings returns. Whenever the Bank of England raises its base rate, banks are quick to adjust loan and mortgage rates, making borrowing more expensive. However, when it comes to rewarding savers, banks often move at a snail's pace. This means that while households pay significantly more on their debts, their savings accounts hardly benefit. For example, during recent years of financial turbulence, some high street banks offered savings rates under 1%, even while inflation was above 8%. That gap represents a direct loss to savers who trust these institutions to preserve their wealth. The illusion of money growing in the bank has been replaced by a harsh truth. Stagnant interest rates make savings lose real value year after year. This imbalance is particularly harmful to those who rely on savings as their main form of financial security. Retirees, for instance, often keep money in traditional accounts, expecting safety and growth, only to realize that their capital is effectively shrinking in purchasing power. Younger savers may also feel trapped, watching their hard-earned money stand still while living costs accelerate. What makes this worse is the lack of transparency. Banks market their accounts as competitive, Yet many savers do not realize they are earning far below the true cost of inflation. When adjusted for rising prices, the real return on many accounts is actually negative. This silent erosion can devastate long-term savings goals, such as buying a home, paying for education, or preparing for retirement. Fortunately, individuals have more options today than ever before to protect themselves. By comparing rates, switching providers, and considering fixed-rate savings bonds, premium bonds, or tax-efficient ISAs, savers can ensure their money is working harder. Some digital-only banks now offer higher yields, reflecting the real competition that traditional institutions avoid. Beyond bank accounts, people may also explore investment funds or index trackers that provide better long-term returns. The message is clear: don't settle for low rates. In an era where banks prioritize borrowers over savers, the responsibility lies with individuals to actively seek opportunities that preserve and grow their wealth. Number 1. Rising inflation and cost of living crisis. Inflation is often called the silent thief, and for good reason. When prices rise, the value of money decreases, meaning your savings can buy less over time. In the UK, the cost of living crisis has made this impact clearer than ever. Everyday essentials, such as food, energy, and transportation, have risen sharply, outpacing wage growth and standard savings returns. Imagine having £10,000 saved in the bank today. If inflation runs at 10%, in just 1 year, that money has the purchasing power of only £9,000. You haven't touched a penny, yet your financial security has quietly shrunk. This erosion is especially dangerous because it feels invisible until households notice they're spending more for the same basket of goods, draining the stability that savings were meant to provide. The danger isn't only about prices going up, it's about interest rates not keeping pace. Many UK banks offer savings accounts with interest rates far below the current inflation rate. For example, if inflation stands at 8%, but your savings account offers only 2%, you're effectively losing 6% of your money's value every year. This gap adds up quickly and devastates long-term savers who trust traditional accounts to safeguard their future. The longer money sits idle in a low-interest account, the more purchasing power it silently surrenders. This creates a hidden risk, especially for retirees or those who rely heavily on their savings for financial stability. The good news is, there are strategies to fight back. Instead of allowing inflation to erode savings, people can explore inflation-linked bonds, high-yield ISAs, or diversified investments that historically outpace rising costs. Even small changes, like switching to accounts offering better interest rates or investing a portion into assets tied to inflation, can help preserve wealth. Some individuals also choose to invest in commodities, such as gold or real estate, which often hold value during turbulent times. The key is awareness, understanding that doing nothing is the riskiest move of all. By actively protecting savings against inflation, households can guard not only their money, but also their future financial freedom. The truth is, many people assume that savings sitting in a bank are automatically safe, yet the reality is far more complicated. From rising inflation and low interest rates, to risks of bank failures, pension instability, government policies, currency devaluation, and cyber threats, every saver in the UK faces challenges that can quietly reduce or even endanger their wealth. What makes these risks particularly dangerous is their subtle nature. Most don't happen overnight, but gradually eroding financial security without people realizing until it's too late. The good news, however, is that awareness creates power. By understanding how savings can be affected, individuals can take steps to protect themselves, whether it's by diversifying assets, spreading money across multiple institutions, reviewing pensions regularly, or staying informed about government and economic policies. Small proactive measures can make a massive difference over time. Building a safety net with emergency funds, exploring inflation-resistant investments, and being mindful of hidden fees are all practical strategies that put control back in your hands. The future of savings is uncertain, especially as the world heads toward a cashless society, but uncertainty does not have to mean helplessness. Each of us has the ability to prepare, adapt, and take responsibility for our own financial security. By being informed and strategic, savers can protect not just their money, but also their independence and peace of mind. The key lesson is simple: don't wait until crisis strikes. Take action now to ensure your savings truly serve you in the future. What do you think is the biggest threat to your savings? Inflation, banks, or government policies? Share your thoughts in the comments. I'd love to hear your perspective. Also, don't miss our previous video, packed with tips to safeguard your money. We pour a lot of effort into creating these guides, so if you found value, please support us with a quick subscribe. It's just one click, but it means the world to us.